Okay, well, thank you very much. Yes, so I was asked on Monday to actually step in. So I did have a couple of days to kind of get my thoughts together. And of course, first of all, also, I mean, I know you have been welcomed already on Monday, of course, by Nicola and others on welcomed here to the EUI, to the Florence School of Banking and Finance. But of course, as a director, I have to kind of repeat that and again, welcome you very warmly. I hope we've been treating you well. I hope you have also put the instructors and the panelists all under a lot of pressure to get as much as possible out of this experience, out of this week here in Florence. So what I want to talk a bit about is I want to kind of look at the whole issue of digital finance slightly a little bit different. And I want to start or kind of want to look at it from the viewpoint of financial innovation, because ultimately that's what we're discussing, different types of financial innovations. So the first question I have actually for you, when I said financial innovation just 10 seconds ago, did you have a positive or a negative reaction? Do you see financial innovation as something positive or negative? So who thinks it is something positive? Oh. Am I in the wrong course? No. Who sees it as negative? Okay, good, at least some. These are supervisors, right? Okay, good. Sorry, no, okay. No, it's interesting. I was asking this because, so my professional background is that I worked for many years more in or on developing countries. I spent 11 years at the World Bank. And when you discuss financial innovation in developing countries, it's typically seen as positive without any conditions. When you talk about financial innovation, or maybe now it's a bit different, but when you talked about financial innovation after the 2008 crisis here in Europe or in the US, most people actually would have reacted negative. They say financial innovations such as securitization, such as new forms of securities all kind of contribute to the global financial crisis. So, but it seems that this memory has faded a little bit, or that you are just more in the camp of the positive effects, which are also there, obviously. But I find this is just an interesting point I want to kind of start off on. Because I want to give you actually examples of positive and negative financial innovation, or actually go a step further and argue that financial innovation per se, yes, it can be positive, it can be neutral, but it also depends a lot on how we let financial innovation develop over time, how we let it unfold, and how we regulate it in terms of what impact it ultimately will have. Now, a lot has been written about, of course, technological innovation, but also financial innovation. Some people have argued that there have been major financial innovation over the last 100, 200, or even 500 years. And actually, one of the first financial innovations was discovered or was implemented here in Florence, double bookkeeping. Of course, then there also have been, for example, bonds, railway bonds, or investment banks to finance railway expansion. Mutual funds is, I think, a new form that was only kind of introduced after World War II. Some people argue, Paul Volcker once said this, that the only useful financial innovation ever was the ATM machine or the cash machine. So there's a long history of financial innovation. With, again, some people arguing it is positive because it contributes to more competition, to more efficiency in the financial system. Ultimately, it benefits the customers. On the other hand, others saying, no, it actually makes people take more risk. It gives the illusion of risk diversification, of risk mitigation, and then eventually things blow up like in 2008. So this is kind of the background, or what people have been saying about financial innovation. Now, I've a couple of, actually, well before, no, 2015, 16, I wrote a paper with a couple of courses where we looked at this empirically, and we kind of actually found evidence for this kind of Janus-faced character of financial innovation. Financial innovation, in this case, measured in very different ways. How much do banks actually spend on R&D, which typically you don't get much information on, but there's some information, or on securitization, or on specific forms of innovation. What we found there is that financial innovation allows banks to expand credit faster. So yes, there is what we economists like to call financial deepening, but it also makes them riskier. And ultimately, when things go wrong, like in 2008, those banks who kind of were more invested in financial innovation actually suffered more in terms of profitability. So it is very kind of, you know, the typical economist thing, on the one hand, on the other hand, very ambiguous. Now, there are some innovation which we kind of unambiguously think are positive. And again, coming from more the developing countryside, you might have heard of M-Pesa, or you've maybe heard of doing this week, this payment platform, or this kind of mobile money platform introduced in Kenya in an environment where there was very few people had bank accounts. When people wanted to send money, there was lots of internal immigration. So when people wanted to send money from Nairobi to their home village, they had to give it to the bus driver and then go immediately to church and pray that the money actually makes it to the other side. So then mobile money came in, and basically you could send money by mobile phone, and 10 seconds later you knew whether the money has arrived or not. So this was kind of a very positive innovation. Of course, the banks, and I'm going to come back to this, the Kenyan banks didn't like it at all at the beginning, because obviously it was competition for them. But ultimately, the governor of the Central Bank of Kenya decided no, he wants to try it out, and it has worked relatively well so far. Other examples, I remember my last time in China was right before the pandemic, 2019. I arrived with some coins, some bills, Chinese money, and I left the country after a week without having spent any of that. Why? Because cash is barely being used anymore in China. You use the QR code, and you use basically a payment system being built up, that was built up by big tech companies such as Alibaba or Tencent. So again, you could argue that's overall a very positive financial innovation. On the other hand, you see The Economist, I talked earlier about securitization, which some people see as having actually contributed to the global financial crisis. Why? Because banks could originate loans, then sell them off without maintaining any share in the original loan, and then just they would get rid of any responsibility, which of course then influences the incentives to properly screen borrowers beforehand and maybe to monitor them afterwards. The same mentioned that the mobile money platforms have become very popular across many developing countries, and they have been partly also being used for consumer credit. So again, we've had this of course also in the US or in other countries. You get a consumer credit within a couple of seconds once you are a good client of the mobile money platform and have established a certain reputation. But of course, getting easy credit can also lead to over-indebtedness, over-borrowing, and ultimately over-indebtedness. And ultimately can both lead to crisis on the individual level, and ultimately, if the numbers are large enough, also on the society level. So again, very different ways of looking at innovation. Some, we would argue, positive, others not positive, negative, or even leading to a crisis. Now, how would we supervisors actually think about that? How should regulators, supervisors think about that? I mean, we like competition, we like innovation, but we clearly see the risk that comes from innovation if it's being used is it being used for the wrong purpose? I mean, yes, you can argue that CDS spreads, for example, just another example, CDS spreads used to insure yourself, but naked CDS spreads, whereas you don't own the underlying asset. Is it again to hedge? Maybe because you have a similar asset, or is it for speculation? Right? So again, there are these two sides. It's very hard to disentangle. So how should we as supervisors think about it? Should we always say, well, let the market decide? Or let it try at the beginning and then monitor it? Or also, and I know that, for example, in the SSM, that's not a big deal, not related to financial innovation, but related to banks, is the business model. What is ultimately behind that? What is actually the benefit for customers? And what are the risks? And how are the risks being built up, monitored, and contained over time? Maybe that's a way for supervisors to look at. Similarly, of course, we know that innovation can affect incumbent providers. Right? Again, the banks in Kenya were against M-Pesa because it kind of undermined their rents. Well, that's not a reason for supervisors to say, No, we won't allow newcomers in there because the existing guy, the incumbent guys, might be threatened in their nice profitability. But of course, it means that when you have innovation, you have more competition. You have to watch out how incumbents react, maybe by taking more risks. That's what the so-called competition fragility hypothesis says. By shrinking, or by just getting under pressure in terms of their solvency. So again, this is something a step further, not just looking at the first round effect of innovation, financial innovation, but then also the second round effects on the incumbent, on other providers of financial services. How do they really react? Will they just copy it? Will they take more risks in other areas? Or will they actually become possibly insolvent? Now, so all of this is what I've discussed so far is about private financial innovation. So either existing financial institutions or new providers. In this case, it wasn't a financial institution. It was, in Kenya, it was a mobile money company, mobile telephony operator. In China, of course, it was the big tech companies. Then the question is, so these were all private providers that basically came in and where the regulator had to kind of react to it. Now, we also have innovation where it is actually can be a public-private partnership. And here, there's this, not sure whether it has been mentioned, but there's this new payments system in Brazil, for example, called PIX, which basically was introduced by the central bank and provides a link between different financial institutions, including banks, but also others, to basically exchange instant payments across different providers, across different agents. Again, this innovation came in on the backdrop of an extremely inefficient system before. So like, I remember when I was last in Brazil, I don't know, 5, 6 years ago, you still could see in the stores and the shops like these 7, 8, 9 different POS, because each bank had kind of their different payment system, which was of course very inefficient. So this, and again, in this case, it was actually the central bank together with the private sector who introduced that. And so again, this is something where you could think as a regulator, as a supervisor, maybe there's an additional role for authorities in order to kind of push innovation if the incumbents just don't want to do it. They just enjoy their current profits, their current, what we economists call rents, monopoly rents, and kind of refuse to become more innovative. And on the other hand, there's no new entrant that is big enough or that wants to kind of spend sufficient fixed costs to enter the market and provide these kind of services. So this is kind of financial innovation in the traditional sense or in the traditional financial system. But I think you also this morning, and I think I saw this morning Thorsten Beck, you also talked a little bit about crypto. And just so this is another Thorsten, so you know at FBF we have a list of pre-approved first names. So Thorsten is on this list, so that's why we have 2 Thorstens. Anyway, right, so crypto is of course something completely different. Because crypto, the idea, and again, I'm not going to talk about the technical details where the other Thorsten is much more fluent in, is of course that its original idea was really to be completely separated from the traditional or centralized financial system. Centralized, and not in the kind of socialist sense or communist sense or whatever, but centralized in the sense that there is when you do payments, there is one central intermediary that stands in between. So completely outside this kind of libertarian approach, which doubts on the usefulness of central banks, of regulators, and kind of believes in the complete free market. Now, Bitcoin is not the first private currency. I remember 20 years ago, my wife and I lived in Washington, D.C. We had very, very young kids, babies, and it happened to be that our neighbors, we were living in a neighborhood with lots of young families. And basically, we started a kind of an informal exchange on babysitting. So one couple wanted to go out, and then we had a little internet platform, but then somebody else could sign up to watch our kids together with their kids, and so on. So this was, and then we got kind of points. I guess nowadays you would call them token or so. We got points, and then you could use these points then in reverse for when I was babysitting my neighbors' kids, and then I could then use these tokens, the points that I got for having my kids being babysit by somebody else, not necessarily the same neighbor, but somebody else in the neighborhood. So that's a private currency too. But of course, the crypto is different because under the scheme I just described, there is something behind it, which is services being provided. In crypto, Bitcoin, there's not really anything. One can argue, right? It's just being mined. I mean, there's a mining effort, but it's not really any real asset or any real service or good behind it that underpins it. And again, the idea was that this would be somehow an alternative to the financial system, to the traditional financial system. Before I came to Florence, I taught in an MBA program in London, Economics 101 basically, and I always asked this question to my students when we talked about money and banking: do you think Bitcoin fulfills the functions of a currency? Very interesting. Most years, the majority of people said no. There was 1 or 2 years where the majority of people actually said yes, it does actually fulfill the function of a money. I never checked whether it had to do with the price of Bitcoin or not. I think by now, most people would argue that, I mean, I would argue strongly that we are in a crypto winter, that crypto is kind of really turning out to be the tulip mania of the 21st century. That, yes, the underlying technology has some values, smart contracts, for example, but the whole idea of crypto, of these ICOs and so on, that this is there's not really that much real value behind it, and it's much more speculative. And of course, there are certain Ponzi schemes behind it, or just people who want to kind of get easy money. Now, the question, of course, is, and it has been, of course, also extensively discussed, is what should the regulator of the centralized, of the traditional financial system do about these crypto? Should we, just as actually my co-chair at the AAC, Steve Cicchetti, once wrote in the FT saying, just, let them burn, let it just go away, and then we ignore it, and everybody invests in crypto on their own risk, and we just hope eventually it will go away. And that's at some point, he actually changed his mind. He doesn't say this anymore, but so it's not extreme anymore, so that's what I'm saying. Or should we regulate it? I think the approach in Europe is more to regulate it. But of course, then the risk is that you also give a certain validation if you have legislation, regulation on it. I mean, again, I would think that the most important issue is really to look at the linkage between the traditional and the decentralized financial system. As long as crypto stays outside, this is, you could argue, is a consumer protection issue, this is a fraud issue, this is whatever you want to call it, but it's not a stability concern for the traditional financial system. But of course, with stable coins and other attempts, there has been the decentralized financial system is actually trying to establish the link between their system and the centralized system. And of course, that's when it becomes a bit tricky, because that's when there might be spillover effects from problems in the crypto world into the traditional financial system. Now, so far, it seems that this is not the case. I mean, I'm kind of worried about this, but actually some of my colleagues at the ESRB actually looked into this, and they found that at least currently there is no risk of spillover from the crypto into the traditional financial system, but certainly something to be keep an eye on. Very last point I want to discuss before I let you go back to drinks and foods. Central bank digital currency, digital euro. Let me again ask you a question. How many of you think that the digital euro is a good idea in general? Okay, no, you don't get fired. No. Okay, oh, there are not many. Okay, and how many think that it's not a good idea? Okay, so I assume that the rest is somewhere in between. Okay, well, is the rest in between, or are you just not sure? In between, or not sure? Well, which is the same, actually. Well, that's not the same, but yeah. Okay, no. I see. Yeah, actually, I'm kind of in between too, although I'm kind of going more and more to the negative side. The interesting thing for me is I talked just over the last 2 weeks, I talked to two former, let's say over the last couple of months, I talked to two members of one former and one current member of the Governing Council of the ECB, and one governor of a European non-Euro, former governor of a non-Euro European Central Bank, and I got very different views. That's what's kind of found interesting. The one view, and I'm not going to say who said what, obviously, one view was that especially smaller countries, so I can say this was the non-Euro former governor, needed for monetary sovereignty. There was the other view saying this is a answer looking for a question. We don't really need it. And it might actually be negative, and that's actually what we wrote in one of these ESRB reports, that it might actually undermine the banking system. And of course, then there's a third view, which I've also found interesting, is that it doesn't really have any use, but it's like an insurance policy. If, for example, the Americans cut us off from their Visa or MasterCard system, which is kind of a worst case scenario, but I guess, yeah, that could happen. So, but then the question again for me is, I mean, if you talk about payment services, wouldn't it then make more sense to really build up a proper payment system that actually allows, which I cannot do. I have accounts across several European countries. I cannot send money immediately, instantly, unless I pay for it across my accounts within the euro area. Is it maybe better to really build up a proper payment system in Europe, which then both retail, wholesale, or do we see the CBDC as only as kind of a second best that kind of replaces that? Which of course would be very much a second best, or maybe even second worst, because ultimately there's supposed to be a limit on it, so you can only send up to, I think, 3,000 or so, if it ever comes to happen. And there might be other restrictions. The question, of course, is what happens if there is bank fragility, if there is a bank run? Will people try to go as much into a CBDC as possible? And if they have maxed out their maximum, am I going to turn to Laura or Nico and say, Nico, you don't have as much money. I have this extra 1,000. Can I give it to you so you can hold for me the money that from this Italian bank which is about to go bankrupt in your CBDC wallet? You see, so there is a bit of an issue here, I would say. And I sometimes think this has not been completely thought through when it comes to the implications of introducing such a central bank digital currency. Now, we have also seen that in most countries, and I'm not sure to which extent Thorsten has talked about it, in most countries where CBDCs have been introduced, they haven't been really that successful in terms of take-up, which for different reasons. I think in China it is because you have already the big tax payment system, you don't need a digital currency. In the smaller countries like Jamaica, Barbados, or also Nigeria, it is just too complicated and people don't necessarily trust it. So again, there is, of course, again, I don't think that the debate is over. I'm not saying that I'm completely against it. I'm definitely not completely in favor of it. But I think there's still lots of questions to be asked and lots of discussions to be had. But I think I've overstayed my welcome, so let me end here. Thanks.